All right, let's get more on this with Paul Sankey, president and lead analyst at Sankey Research. Paul, great to see you.
Hi.
You know, the last time we talked to you, China's lockdowns are still firmly in place, and now they're largely lifted. And it seems like that could be the incremental factor. If you thought things were tight before and that oil was going to remain high before, it seems like it should theoretically, your forecast should be even higher today based on the lockdowns coming off.
Yeah, I mean, I think if you remember maybe a couple of times back, really post the Ukraine invasion, we started saying 110 to 150 this summer dollars a barrel of Brent. And as you know, we sort of dipped down actually towards 100 at one point. But again, now you're firmly back in that range. And with China coming back in, and I think the other very bullish thing here is that actually Russia has continued selling oil. So we actually haven't lost the Russian crude. We've lost the Russian oil products, but the actual crude has stayed elevated, as has the natural gas. And we haven't had China in. So the setup is still very bullish and challenging for all your inflation concerns, I have to say.
Hey, Paul, it's Tim. I think Brent or crude, depending on what you're looking at, is going to 140 at least. And I hear this whole dynamic with Russia in terms of their ability to produce really falling off. So swing capacity, what's out there? Because that, to me, is the marginal movement in the oil price from here.
Well, as you know, for the past decade, we really relied on U.S. growth, and the U.S. is not growing. And that's super significant in natural gas markets right now. We're somewhat pondering whether Bitcoin mining may be affecting the U.S. gas production numbers. But U.S. natural gas, as you know, is up at $9 per MMBTU. And I was discussing it with a major client today, and he was asking, do you seriously think we could go to $20 per MMBTU? Most brokers will be using a forecast for next year of like $4. So, there is risk, enormous risk to the upside in all these commodity markets. And we're just not seeing much sign of demand destruction. Again, further to your comments about Walmart, et cetera, really, we're not seeing significant oil demand destruction globally or natural gas demand destruction. And so these prices remain, under significant upward pressure.
Paul, it's Karen. Let me first congratulate you. You made a call, long marathon, short Rivian, which was fantastic on both sides. And so I'm going to put you on the spot right now. What pairs trade would you have? I don't know if there's another elevated sector like Rivian at the time, but putting you on the spot, what pairs trade do you have?
Actually, Rivian got all the way down to its cash, more or less to its cash and its balance sheet, but then bounced back up, and we put the trade back on. The one I've been talking about is more conceptual, as you know, is generally long oil, short tech, or short NASDAQ. And we've been talking just out of interest that both Exxon and NVIDIA have about the same market cap. The problem with NVIDIA, as you know, is a very good company with a really good CEO. So, I don't want to hate on it too much, but the conceptual theme of multiples compressing will continue to favor the oils over basically the NASDAQ. Another interesting one to me is, a great company like Microsoft. If you look at its share of the S&P 500 earnings, it's at about the same level as it was 5 or 6 years ago. The entire move in the stock was multiple expansion. So if we get into a rising interest rate, rising cost of capital market, these very big, even very good companies can continue to go down. Whereas, as you said, something like Exxon, I just checked next year's earnings. It's forecast to make $10. I think it could make 14, and the stock's at 100. So, it's at 10 times an earnings number that looks too low.